What is up, everybody? My name is John Gwelly. Today, what I'm going to be talking about is life insurance, and I'm going to be explaining it in a way for dummies, right? Really simple, really easy. And I'm going to be explaining, types of life insurance policies, what they're for, or typically what they're for in a simple way. That way you can understand, and if, eventually you get your own policy, you can use this video as a reference to understand what would better fit you and your needs, right? So, to get started here, what is life insurance, right? And there's a couple different ways to explain it, but the gist of it is it's a contract that pays a death benefit if you pass away, right? You can design it in a bunch of different ways, but some people use it to some people use it to protect their family's finances. Some people use it to help cover the rent or mortgage, maybe debt, child care, income replacement when they pass away for their family, right? What happens is when you get a life insurance policy, what you do is you pay something called a premium, right? And you pay a premium either monthly, semi-yearly, yearly, right? And what happens is if you pass away, that money that you're covered for, that death benefit, gets paid out to your family, paid out to your beneficiary, and specifically. And I'll go over what that means in just a second. And life insurance is also something that is based off your age and your health. So it's not like car insurance, it's not like home insurance, right? This is something based off your age and your health. So just a quick tip here, the younger and the healthier you are, the cheaper your insurance is going to be. Or your cost per insurance is going to be cheaper. The older you are and the more unhealthier you are, it's going to be more expensive, right? So here are 6 terms that you need to know. The first one is premium, right? This is really simple. Premium is what you pay. It's your monthly premium, your semi-annual, annual premium. This is what pays this is what you pay that goes into the policy, right? The second is death benefit. The death benefit is money paid out when you die. When you pass away, your beneficiary, which is the third one, beneficiary is who gets the money. Your death benefit gets paid out to your beneficiary when you pass away, right? Another key term is cash value. Cash value works differently in different policies, but the essential gist of what it means is it's a savings like account. Basically, a portion of your premium, depending on the policy. Some policies don't have cash value, but a portion of your premium goes into what's called your cash value, which is a savings like account. And this is money that you'll be able to pull out. And most people use it for emergency funds or even a vacation after they pay in their policy for a while. They use it to go on vacation, whatever the case might be. But you can pull this money out, right? The fifth one is term length. So typically with term policies, it's how long your coverage lasts. So 10, 15, 20, 25, 30 years. And then the next one is living benefits. And typically there are different living benefits, but the essential is early access to your death benefit while you're still living. And what that means is if you meet certain criteria, like if certain health conditions pop up or you get diagnosed with a disease and they say you have 12 to 24 months left to live, you can have early access to a portion of your death benefit while you're still alive, okay? So here are the main types of life insurance, right? We got term insurance, whole life insurance, and an IUL, which is also known as the Index Universal Life Insurance Policy. I don't know why I paused there. So let's get started, right? Term insurance, term life insurance. What is it? It's coverage that lasts for a specific time, 10, 15, 20, 30 years, right? It's built for pure protection. Typically, it's the cheapest way to get a large death benefit. And what that means is if you think about it, a term life insurance policy is like you're renting a policy. It's like you're renting a car. It might be cheaper than owning it, right? But you're covered for so much money, right? The thing is about term life insurance policies is for a specific time. So if you outlive the term, if let's say you get a term for 30 years and you live for 31 years, right? After that 30-year mark, you're not covered anymore. But sometimes you have an option to renew your coverage. But 30 years later, like I said, life insurance is based off your age and health. It doesn't renew that same premium. What it does is it costs more now because you're older. You're 30 years older than what you were when you got the policy, right? So if you outlive the term, coverage ends. That's it. Maybe you can renew it, maybe you can't. And then it's best when you have temporary needs, right? Like, let's say you're a 25-year-old and you just got a mortgage for your house. You have one kid, or you have kids. You have one or two kids, or you're the main breadwinner of your family, right? Typically, the term insurance is used for the most part when people have large mortgages they want to cover. They use it in a way where, let's say I owe $150,000 on my home, right? And let's say I'm the main breadwinner. And let's say I passed away 5 years in and I paid off, let's say, $20,000 of that mortgage. So now we're at $130,000. My wife, my kids, if I'm the main breadwinner, they're not going to be able to stay in the home. They're not going to be able to stay in it if they can't pay the mortgage, like pay their monthly mortgage rate or whatever the case might be. When you have a term insurance policy, when you pass away, that death benefit gets paid to your beneficiary. Most cases is people's spouses or their children. They can use this money to pay for their final expenses. They can use it to pay for anything. I mean, they can use it to go gamble if they wanted to, right? But typically people get the term so their family can pay off the mortgage so they can stay in the home. That's why when you hear mortgage protection, someone tries to sell you mortgage protection, or if you are in sales and you try to sell mortgage protection, term insurance is like the go-to because it fits that need. You have a mortgage for 15 years, here's a 15-year term policy. After 15 years, you have no more coverage, right? Simple. And it can be used for other things as well, but this is just typically of what it's used for. There's no really benefits on it unless people add them. I'm not too adverse in term policies, but this is just the gist of it. So who is it for, right? Like I said, it's for people with kids or dependents. It's people with a mortgage or major debt. Families that need income replacement if something happens to the main breadwinner. It's more for budget-focused protection if you're not really willing to spend too much money, right? It's more for people who are more of a renter than an owner, right? And there's nothing wrong with that. But this is typically who it's for, right? Term policies, every policy works differently. It's meant for different things. I think term insurance is great. But one thing I do want to say, and this is a fact, I don't know the exact amount. It's between 95 and 99%, somewhere around there, of term policies do not pay out. That's why it's more like renting, right? There's a good chance you're going to outlive your term policy. And I'm saying if you pass away within that term time, you're still going to, your death benefit's still going to get paid out to your family, right? But most of the time, people outlive it. So if you're looking for guaranteed coverage, this might not be for you, right? If you're looking for something that's going to last your whole life, this might not be for you. But if you like the idea of renting something, just borrowing it, paying a cheap premium, go ahead. Term would be the best solution for that. And like I said, you don't have to take what I say at face value, but I'm just giving you guys information so you can make better decisions moving forward. So with that being said, the next thing I want to get into is whole life insurance, right? So this is coverage that lasts your entire life as long as the premiums are paid. This has cash value that grows over time. So how whole life insurance cash value works, for the most part, it's a portion of your premium. And whole life, you can't adjust your premium or anything. The premium is fixed. So if they say you got to pay $150 a month, that's how much you got to pay. Right. So a portion of that goes into your cash value, and you can access that money. Typically, it's after a few years, between 2 and 5 years, you'll be able to access that money. But then you can just borrow it from the policy. And in most cases, it's like a loan. You might have to pay it back. But you don't have to pay it back necessarily. But it just depends how you want it to work, right? But the death benefit is usually guaranteed. And typically what whole life insurance is for, and like I said, you can use it for different purposes. But typically, it's used for final expenses. I know tons of people get calls, and people call them to sell them final expense insurance. They also call this final expense. Whole life, final expense, they go hand in hand. But whole life is literally in the name. Whole life. As long as you make your payments, your premium, last your whole life. And something cool with the cash value is, let's say you had a whole life policy for 30 years. You already have some cash value in there, right? So now typically what happens is some people stop paying their policy, right? And instead of them paying out of their pocket, it takes it out of the cash value. So now it's like they have free coverage, right? Because, well, it's not free, but it's like using your reward points after you stacked them up for years. That's typically how cash value works if you decided to pay your premium that way, right? Who is it for, or why some people choose it? Sometimes people want lifetime coverage. They want to make sure they can cover their final expenses. Final expenses aren't cheap. When it comes to cremation's usually cheaper, but that still costs a few $1,000s. Burial, final expenses, burial, funeral, stuff like that, that costs about 15, 20,000, depending. I mean, it could be cheaper, but it's still expensive. A lot of times family don't have the money to come out of their pocket with it. So they have to do GoFundMe's, they have to ask family members for money, they got to pull money together. That's why a lot of people get whole life insurance. You pay more, you get less coverage than a term, but it'll last your life. It lasts for the rest of your life. And it can be used for long-term planning depending on how you use it, right? Another reason why some people choose it is because it has living benefits. So there's something called a chronic and terminal illness rider. So if you get diagnosed with a chronic illness, I believe you're unable to perform 2 out of the 5 daily living activities, you get to take out a certain percentage of your life insurance policy. Some companies give you 50%, some give you 30, some give you 70, maybe even 80 or 90% of the death benefit. And you don't have to pay that money back. You can use it to cover your medical expenses, or some people might not use it to cover medical expenses. Maybe they use it to go to the casino and gamble, right? But that's why a lot of people get whole life, is because they have access to those living benefits. And also, they might be in the mindset of being more so of an owner than a renter. And obviously it's literally the opposite of a term policy. You own this for life. This is something that you can pay on. I'm a 21-year-old. If I got a whole life policy today, and I can pay until the day I die. And then when I pass away, my family gets paid out, right? So this is why some people choose whole life. And the next one, obviously, the IUL. So this is an indexed universal life insurance policy. IUL is a permanent life insurance with cash value, but the cash value works differently. So the cash value in a IUL, the growth is linked to a market index, for example, the S&P 500. But it's not invested directly into the market. It's linked to a market index, right? It usually has a cap and a floor. So what that means is, I'll give you an example. So let's say you're paying, I don't know, $150 a month. Let's say $50 goes to your cash value. Your cash value is building on interest, compounding interest. So let's say the average rate right now is 7%. So you have a floor. So if the market crashes, right? If you have your money invested directly in the market, and the market crashes, it goes negative or it goes all the way down to zero, you lose everything you have. So if I had $1,000 in the market and it crashes, I get $0 now, right? Obviously your money can come back, but if your market crashes like back in '08, you lose everything. What an IUL does is it has a floor at, let's say on the safe side, it's 0%. So you'll never, if the market goes below 0%, you will not lose a single dollar. Your money stays the exact same as it was when it was growing. So if you had $1,000 and it grew and now it's 1,500 and the market crashes, now it's stuck at $1,500, right? to pay 175 anymore, but let's bring it down, and you can bring it down, and it's flexible. Um, it, it's flexible. It has cash value linked to an index, has living benefits the same as a whole life, and it's more complex. But before I let you guys go, whole life policies and IULs do have cash value, but the cash value is different. And I want you to do research on that because I don't want to give you any wrong information, but they are different. IULs are more complex. IULs can, in my opinion, generate you more money. But like I said, none of these policies are better than the other one. It's just depending on what you're looking for. So, with that being said, final thoughts here. Life insurance basically is financial protection. Term, whole life, IUL, they all have a place in this world. They're all used for different things. Um, but one thing is, if you get a call or you're looking and you're talking to an agent, don't buy based on fear, right? If they're scaring you into getting it, don't buy it if they're, you know, hyping you up, saying, "Man, this is the best thing ever. If you get this now, you'll never regret it," right? You want to do your own research. Obviously, you can't negotiate with the price on like a whole life or a term. You can't negotiate on the price because those are set prices. If they say it's $50 a month for this amount of coverage, then it's $50 a month for that amount of coverage. You can't negotiate. But what you can do is you can look at what would best suit you. So if a term best suits you, get a term. If whole life best suits you, get a whole life. If an IUL best suits you, get an IUL, right? It's not my place to tell you what to get, but based on the information I provided, I hope I can help you with that answer. So without further ado, if you found anything what I said today interesting or valuable, please like, comment, and subscribe, and you'll see more stuff from me. Have a good one.